Good morning, everybody. How are you? This is Olga Sedela from Citizens Bank, and today I want to teach you regarding all the different options for co-op. House co-op is different than any other type of properties, and what programs are available for co-ops. Actually, what programs are available everywhere, but especially for co-ops. So, the difference between co-op and a condo and a house is the ownership. The ownership, for example, on a condo and a house, people own the property. On the co-op, they own shares not on in the corporation, not the property. Stock and lease will give them ability to own the shares, and proprietary lease will give them ability to occupy a specific unit in corporation. Now, the biggest difference between co-op and other properties, there's a different level of approval. So when you as a real estate agent are gonna show property for co-op, you need to find out what's a management requirement for that particular building. It's extremely important. Why? It's because not only the client have to pass the bank, but much harder to pass the board. Why? It's because bank requirement, believe it or not, is much more flexible than co-op requirement, especially on debt to income ratio, on post-closing reserves, on the credit history and latencies, and on how many people could occupy a special, any unit. So, for example, debt to income ratio for the most of the banks on the regular conforming limits could be pushed above 45%, while on most of the boards, especially in Queens, the DTI ranges between 25 on the low side and 35 on the high side. So you could see when the bank pre-approved the client, we pre-approve for the bank, but you need to make sure you would pre-approve for the board. When I do the pre-approval, because I do a lot of co-ops, I pre-approve for co-op, not only for the bank, because if you approve for co-op, you definitely approve for the bank. So post-closing reserve. Most of co-ops require minimum 6 months. Some majority requires a year, and some requires 24 months. Now, it's a post-closing reserve. It's for mortgage and maintenance, multiplied by 6 or 12 or 24, depending on the requirement. Most of the banks, if you don't have other properties, if you buy it on a Fannie Mae requirement, they do not require reserves. And if you do require reserves, we could use reserve from 401k, from pension, while board will not use retirement account as reserves. It has to be liquid. For us, it doesn't have to be liquid. It could be just the pension account. We take 70% of the funds available, part of the reserves, if we do require. The other difference is board approval. Co-op and condo and a house don't require board approval. Well, some condos do, but if they don't allow a buyer to buy, a condo must buy themselves. Majority of times, condo just needs application. It's not a scrutinizing review as co-op does. Sometimes even a very good qualified people do not pass the board. Board doesn't have to give you a reason why is it decline a purchaser. A lot of times they decline a purchaser because they don't want to sell too low. Now, if you have that case, please reach out to me. We have ability to do decoration credit, so I could tell you more about that. On a condo, you don't have that problem, and on a house, you don't have that problem. Another big difference is the closing cost. On a co-op, closing cost roughly about $4,500 from a banking side. That includes appraisal, lien search, which is buyer's attorney does, bank attorney, credit report, flood insurance, and prepaid expenses. On a condo in a house, it could range between 3 to 5% of the loan amount. So it's a huge difference. All three properties have to pay mansion tax if a purchase price $1 million and above. But majority in Queens, you're not gonna see $1 million co-op properties, but you do come across them sometimes. So that's another huge difference between co-op and a condo. So the next thing is what other bankers will we look for is while a client has a board, we have to make sure the project is approved as well. Now, sometimes people ask me, but in a project, there's 6 buildings. 5 buildings have a good inspection report. Only 1 building has a unsafe finding. Can I still finance the building? And the answer is, if you have incorporation, whether it's 5 buildings or 1 building, if 1 building is unsafe, the whole corporation considered unmortgageable for Fannie Mae and Freddie Mac. Sonia Ma and portfolio lending don't look at inspection report. However, if we start financing conventional and find out that the building is not the report is an unsafe findings, then we could switch it to Sonia Ma, or we could switch it to portfolio. On a portfolio lending, so the Sonia Ma, it's a little bit different underwriting. So on portfolio lending, we do require 9 months post-closing reserves. We could use a pension account or stock accounts, 70% as a reserves. 5% of funds have to be your own funds, while conventional, everything would be gifted as long as you put 20% down. Could be gifted. So it's a little bit different options. Now let's talk about on the co-op. On co-op, we have a lot of different projects, a lot of different financing programs. You could do conventional, which sold to Fannie Mae and Freddie Mac. You could do Sonia Ma. You could do portfolio. You could do home ready. So there's a bunch of different programs. Now, how do we identify which program works best for a client? It depends. So, for example, if I have a client fits into home ready, and we could get $5,000 grant, which doesn't have to be paid back, it might be better than Sonia Ma. Why? It's because on Sonia Ma, while the rate 6.125, with a grant, it will be much higher. So when we take a loan, we review all the options with the client to see what best suits their needs. Sometimes, for example, if I have a client with $300,000 student loans, which was deferred, Fannie Mae requirements on the student loans is 1% outstanding balance. Even though it's deferred, we're going to hit the client as a debt 1%. Co-op will not hit you for the debt, but the banks will. So with $3,000 expense on a monthly basis, client might not qualify even for the bank. So what we do is we might switch it to Freddie Mac. Freddie Mac only will hit you with 0.5%, and Sonia Ma also will hit you with 0.5%. However, if the student loans are for medical school, and the client is finished to be a doctor, we could eliminate. We don't have to hit them with 0.5%. We see how far is deferred. If it's deferred more than a year, we could qualify without hitting them for an expense. So it is so much moving parts to qualify. So it's extremely important when you take a client to see the property, make sure they got pre-approved, not pre-qualified. What's the difference between pre-approval and pre-qualification? Pre-approval, the lender loan officer physically review all the documents. They pull the credit report, they review income, they review assets, they review every documentation that is required. Pre-qual, we take the word of the client. I said, okay, I'm making X amount of money. and I have enough money for down payment, I have enough money for reserve, but that is not verified. So it's a little bit dangerous, especially when you ask a person, how much money you make? People, especially the self-employed, would give you an answer that of a gross income, not net income. Bank always use net adjustable gross income, so does the board. So you gotta be careful. You have to make sure people get pre-approved. Now, how would you know if the banker looked at the documents? Because sometimes it's not the bank, it's a person who's doing the work. You just need to call the loan officer on a pre-approval letter and ask them, have you physically looked at all the documents? What's the debt income ratio? What's a reserve? Before you call the lender, make sure the client give authorization to the lender to release their information. If they didn't look at the documents, they wouldn't be able to answer to you what's the debt income ratio, what is a reserve post-closing. So you just gotta really, really double check that. Because when you issue pre-approval, the listing agent takes this as, in a good value, because they make sure that, the client is reasonable, they'll be able to pass the board. To lose time and effort to get the contract just to find out they're not qualified. Another thing you gotta take a look at the co-op is not only the client's approval, but the project approval. In the last 2 years, we had a lot of challenges to get a project approval. Why? Is because when in Florida the building collapsed, it really didn't hit New York hard. It did hit Florida approval of the land. But when in Bronx building collapsed, it hit New York very hard. In September, 2 years ago, Fannie Mae and Freddie Mac put institution that every building needs to pass the inspection without unsafe findings. In the beginning, we had a lot of management will answer questions incorrectly or will not answer it at all. So how did we find out the questions were not answered correctly? Part of the Fannie Mae requirement, they created an addendum. Fannie Mae questionnaire became 2-part of questionnaire, a regular questionnaire plus an addendum. In an addendum questionnaire, there's a lot of questions regarding inspection, if inspection were taking place, when it took place, what kind of findings were there, if there's any unsafe findings, what have been done if it's unsafe findings, what have money put aside to fix the problem. So when the management responded, no, there was no unsafe findings. Lenders get the loan down, sell it to Fannie Mae. Fannie Mae spot check through the building department and find out they did have the unsafe findings. So as soon as they found out, they return loans back to the lender and says, we cannot buy that loan. Believe me, lenders are not in the business to keep the loans for 30 years in their books. So now they're asking, not only asking the questions, they double checking with building department. So every questionnaire gets cross-referenced with building department. And if the answer is no, everything is safe, our inspection went very well, they go into building department and they spot check and they pull inspection reports themselves. And when the management don't answer correctly, they send the inspection report, or they said, oh, based on inspection such and such date, here's unsafe findings, please let us know what have been done for them. Now, they no longer take the word of the management. They want a letter from engineer with a contractor confirming what have been done, what expenses occurred, what expenses will occur. There's a balance sheet of the corporation shows enough money put aside for those kind of repairs. This became extremely, extremely important because Fannie Mae said any buildings that has unsafe findings, they will not buy the loan. What does it mean? that means lenders cannot originate the loan, because if they don't have a buyer to sell the loan, they cannot originate the loan. So what do? We also have the same, Fannie Mae will not buy the loans from us as well. It's not only one bank, it's all the banks. So we instituted portfolio, we have a portfolio lending, depending how severe is unsafe finding, depending where the corporation is with repairs, and if they have enough funds to put aside, my finances under portfolio lending. With portfolio lending, there is a different underwriting. So we have to make sure the client has 3 active trade lines for 24 months. We have to make sure that the client has 9 months post-closing reserves. Could be 680, that's not a problem. And most of the co-op will require higher than 680. And so we need to have, and 5% have to be their funds. If it doesn't meet that, and the debt to income ratio cannot be more than 45%. If it doesn't meet those requirements, then we cannot do on the portfolio. We have another option with SONIMA. SONIMA do not look at the inspection report. Their questionnaire do not have addendum. But on the phone, SONIMA, they also have to have 3 trade lines. The beauty of SONIMA, even though they have to have 3 trade lines, if they only have 2, we could do non-traditional trade line. We could show that the client paid 12 months of rent, and we could build the trade line. They do not require post-closing reserve, and 1% could be their client's funds. Everything else could be gifted. So there's a lot of flexibility to see what can or cannot be done. On the SONIMA, must be first-time buyer, and on the SONIMA, must occupy the property for life of the owning the property. While conventional, you could buy the property, a couple of years you could rent the property. SONIMA, you always have to occupy the property as a prime resident. So when we review each different lending, we have to review with clients what's their future for this co-op. If the future is to live there 1 to 2 years and then rent it, so SONIMA might not be the best project for them. So we have to explain all the pros and cons for every financing opportunities. And we have to make sure that the clients are comfortable with that, because not everybody have it's not like one size fits all. It's all tailored to each client individually. Another issue with the co-op approval is when property lease expires. So each bank will finance it before property lease expires. So we are in 2025. If property lease expired in 2050, then 30-year mortgage is not going to be available for that particular co-op unless we get in writing that they are changing to longer expiration dates. So what did we do? We could do 15-year mortgage, we could do 20-year mortgage, depending on the program. So it does have flexibility, but you need to make sure they qualify on the shorter terms of the mortgage, because the shorter the term, the more higher the payment. So that's another thing we gotta keep an eye. So with beauty of Citizens Bank, we have a huge database. We could look at a co-op. If you give me the name of a co-op and the address, I could look up in our database. I could see when property lease expires, when underlying mortgage expires. That's another thing is we're gonna keep an eye on. Because if underlying mortgage, meaning the mortgage for the building, expires less than 6 months of the originating of the loan, the bank will not be able to close the loan. So we need to take a look at that, because it's a very, very, very important. Why does a bank care about when the building refinance their mortgage? Because majority of buildings carry a large mortgage, and if they cannot refinance, then bank don't want to have loans in that building. It could be more risky for that. So those are key points on approving the co-op. Another huge issue is insurance. Now, I just picked up a loan where Citibank declined the building because of the insurance. Let's say we have a corporation with 5 buildings. Each building have to be insured separately. It cannot be blanket insurance anymore. And the reason why is when Sandy hit us hard, some building got affected, and when they had only blanket insurance, it did not have enough funds to fix up the buildings. So each building had to have a separate insurance. However, why were we able to do the portfolio versus Citibank could not do it? Is our underwriter, a project underwriter, requested a full copy of the policy. And when they reviewed the policy, they identified they have more than enough coverage for each building. But insurance is extremely, extremely important part of the approval. We also look at not only master insurance, which cover the whole building and liabilities and all other stuff. We also look at crime insurance. Crime insurance is tied into revenue. We have to have, so let's say revenue is 10 million, we have to have four times of maintenance insurance. So if it's not enough insurance for crime, that would be a stop blocking of approval as well. So we have a separate department while underwriter working to approve the client, borrower. We have a separate department who approves the building. And it goes the same thing with co-op and the condo. It's, it's a really separate building. The underwriter is just specifically trained to underwrite to approve the project. Another huge thing on the co-op questionnaire is if you have litigations. Litigation is a big flag for the banks. Why? It's because it's a corporation, and litigation could wipe out all the profits of corporation, and it also could wipe out equity of corporation, depending how much they got sued for, what are they got sued for, is insurance covering the lawsuit. So, for example, in building Park City 3 and 4, there are multiple lawsuits, multiple litigations, and slowly but surely, all the banks flagged that particular building might not be in a good, strong financial situation because they've been sued a lot. We put this on the decline list, so the Chase and the judge got hit with another litigation, so they have to clean up some litigation in order to banks start financing again. Now, some litigations are not that bad because they're covered by insurance. So what we do is we get a letter from co-op attorney, we get a letter from insurance company stating that they will be covered by insurance and it's not going to affect financials of the corporation. So that's another huge thing. We also picked up another file with in Harvard Beach. There was a fire in the building. So one line got affected. It was a fire about a year ago. It's taken corporation more than a year to fix up the line. And even though our buyer bought a separate different line that did not affect all the fire, we still had to go through portfolio lending. Why? Is because, Fannie Mae will not buy the loan if they have partial vacancy. And they are projecting that fully will be, all the shareholders will be moved back in the next year or so. That was tough to approve the building with a fire, but we got that done. So as you could see, there's a lot of moving parts when you work with a co-op and the condos, because not only qualify the client, we have to make sure the building is approved. So if you have any project that you wanna do the listing in that project, shoot me the email. There's no, there's no street attached. I could tell you whether if it's an approved building, what expired and what do we see as a yellow flag. Sometimes we see not only yellow flags, we also see the red flags as well. And we could share with you, and then you could figure out whether you could accept a cash purchase or how you could maneuver and what banks could finance. Now, let's say, for example, no banks finance. What's your options? Well, cash buyer is always an option, but there's also another option. Take a look on the financials. Who financed underlying mortgage? So if let's just for argument's sake, the underlying mortgage was done by NCB. Most of the time, if the underlying mortgage, that lender will finance in the building for individual purchases. Why? It's because they already took a risk with underlying mortgage. They feel comfortable and they would underwrite that particular loan. So I see a lot of times when in the building NCB underlying mortgage, people go to NCB to get financing in that particular property. Now, sometimes that particular NCB might be slightly more down payment, might be slightly higher interest rate, but it definitely could qualify if the lender is willing to lend and the buyer doesn't have cash to purchase. A lot of times I tell people, listen, when you review financials of corporation, don't always think that, oh my God, financials shows the losses in the building. If you buy co-op, you can be, as a lender, review the financials very carefully. And if you take the risk, the biggest risk is always done by the lender if you only put in 20%. Now, how do we identify, should we take the risk on the financials that shows the losses? We review with a management to find out why the losses happen. In the last year to 2 years, majority losses happened because they had to fix a lot of things in order to pass the inspection report. Not necessarily they had unsafe findings, but they probably had some findings that was not so severe, but still needs to be fixed. So the bank will take a look and see where did money go. So we had one corporation, one co-op that showed $1 million loss. So majority of banks did not qualify, but we went to Fannie Mae and said, listen, the reason there was $1 million loss 1 year and much lower loss next year is because the building went through a lot of repairs and renovation. It's a one-time thing. And we showed the budgets for 2025, showing the healthier financials, and we were able to get it approved. So just because you see a negative number, it doesn't mean it's automatically no. But we do need to dive further to see why, what happened, what corporations do that it doesn't happen, does they have enough assessment, increase in the maintenance to cover the loss for future, and if the repairs are fixed, and if not, then we need to see how much money got put aside for repairs. We always take a look at the corporation have enough reserve, not only to fix the property, but for any future, issues that could come up. So those are things that from lender's side, but from you as an agent, you probably wouldn't know everything. So what you could do is just reach out to loan officers, see if that's an approved list, see if you have yellow or red lights or green light. So just because it was a yellow light today doesn't mean in a month from now it turns to green light, and vice versa. Just because it's on the green light today, it could turn to yellow or red light tomorrow, because buildings get reviewed constantly. Annual report, annual financial statements gets reviewed annually. Majority corporations have their financial due in May, and we give them 3 months grace period. By end of August, we already start saying, hello, we want current financials of prior year, 2024, and if you don't have it, why? What's a holdup? We want a budget for 2025. So we scrutinize financials very, very carefully. What else? So we mentioned that difference between co-op and account is a board approval. So let's say we approve the building, we approve the client, and now we have to wait for the board approval. A lot of times, and I had a client approve, I approved, but then they went to Chase and they locked the rate for 60 days without even signing the contract. And I told them, I said, listen, 60-day lock on the co-op is a very aggressive step. What's going to happen is you're not going to close in 60 days. You're going to pay 30 days extension. It will cost you a lot of money for extension. So when we take a loan, we explain to clients the process of a co-op approval. Now, just because you're ready doesn't mean co-op will meet with you for interview. Even after interview, sometimes take 2 to 3 weeks for the co-op to clear the file. And then usually after board approval, attorneys does a lien search. If there's issues on the lien search, you cannot close. Lien search must be cleared before we close the loan. Now, I hear a lot from real estate agents and the clients. Oh, the unit is empty. The seller is ready to close. That's why we lock the rate for 60 days. Well, remember, it's not only when the seller ready or a buyer ready, it's when if the lien search has any issues, and unless you run lien search, you won't know. And most of the attorneys don't want to run lien search until a client passes the board because they don't want to be responsible to pay for lien search without clients passing the board. But also, when is a co-op is ready to close? I had co-op, I cleared the file, and sometimes it takes a month for co-op to be ready to close. Another thing is that we have to make sure when you lock the rate, check with the seller if attorney orders stock on lease. What does it mean? Well, if a seller has a mortgage, the stock on lease is kept by their lender. If the attorney don't order stock on lease, sometimes it could take 2 to 3 weeks for the stock on lease to arrive. Without a regional stock on lease, you cannot close. So you see, it's a lot of moving parts on the co-op. We usually don't suggest locking the rate in the beginning of the process, especially for 60 days. Citizens Bank has 90-day lock, the same course as 60 days. But even with 90-day lock, in the beginning of a process, if the rates move sideways, a little bit up, a little bit down, we do not suggest locking the rate until at least you submit a board package. Because as you could see, you might be ready, seller might be ready, but it could be a lien search issue. It could be that a bank lost stock lease certificate, and that will take a while to recuperate back. So because it's a lot of moving parts, I usually, before locking the rate, I review with the buyer's attorney, make sure that they review with the seller attorney that ordered stock on lease, that everything is ready before we lock the rate. This way, it will eliminate the extension fee. Now, sometimes buyers call and say, "Look, I still want to lock the rate." Buyers are in control. We could only give suggestions why we don't suggest to lock it or not to lock it. And buyers are kings. If they say to lock it, I want to make sure I get it in writing. I inform the attorney that we are planning to lock. Please make sure that you let the other side know. We do not speak with the other side. We only speak with buyer attorney, and the buyer attorney, review the information with the other side to make sure that everybody understand that the lot was done, and then, and hopefully we could all close within a lock period of time. What happens if we don't close in a lock period of time? Couple of things. If the rate is the same as you locked it, then we could extend the rate at no cost to you for 2 weeks. However, if the rate is higher than you locked it, then there is a cost to extension. So 30-day extension could cost you up to a 15-day extension could cost you up to a quarter. 30-day extension could cost you 0.375 a loan amount. You could have 3 extensions in order to qualify. Or you could let the rate expire. If you let the rate expire and the market rate is lower than the rate you originally locked it, we go with the highest of the two. So if you lock it at 6%, if the market rate is 5.75, we're still gonna keep relock it at 6%. Unless you wait for 30 days. If you don't lock for 30 days, then you could get a market rate. And if, so those are options you have. Fannie Mae, 90 days lock at the same rate for co-op and a condo as 60 days. But on the house, we do 60-day lock. There is no the same rate for 90-day lock. SONIMA locks automatically for 120 days. So that's another feature that SONIMA has. What happens if a rate drops tremendously? And we have that situation. So let's say you lock it at 6%, and in 60 days, rates drop to 5.25. We could renegotiate the rate, but you're still going to lose 1/8 of the rate. You're not going to get a market rate, but you could still negotiate the rate. Let's see what else. So when we get clear to close, we notify the client, we notify the attorneys, and we notify a real estate agent that we got clear to close. Oh, one thing that also difference between a co-op and a condo. On a co-op, you have ESTEC agreement, also known as recognition agreement. What's ESTEC agreement and recognition agreement? It's agreement between co-op management and a bank. But why does it come in the 3 originals? Because, and they have to be signed by the bank, by the borrowers, and management. And the reason why is because why does a buyer have to sign? Is because they're going to talk about the buyer. Management have to tell the bank if the buyer in arrears in the maintenance. Vice versa, bank have to tell the management if the borrower is behind on a mortgage. So without that agreement, you cannot close. That agreement have to be executed by 3 parties, and they have to be part of your closing package. A lot of times we mail the agreement right away. Before we get a commitment letter, before we get a project approval, we get that out right away, and we tell the client that please check with real estate agent to make sure is it go with a board package or is it go separately. It have to be signed by the president of the board or the manager. Let's see if I missed anything. Does anybody has any questions? While I'm taking a look. Oh. Remember we reviewed the closing cost for the co-op? Usually it's $4,500. However, it depends. For example, on a couple of buildings, it states that flip tax is paid half by the buyer and half by the seller. So we gotta pick that up. So depending where the client buys, that flip tax, usually flip tax paid by the seller, but sometimes some corporation makes it 50-50. Flip tax cannot be more than 5% of a purchase price. If it's more than 5% of a purchase price, banks will not finance in the building, because why would the bank care how much seller have to pay the flip tax? It's because if they're gonna finance in the building and the client goes under foreclosure, banks become a seller. And the banks don't want to lose another more than 5% in order to sell the property. So the flip tax is very, very important. Most of the contract will specify if there is any flip tax, and also specify if it's a sponsor unit. A lot of times sponsors put buyer to pay transfer tax. It's not a flip tax, it's a transfer tax. Transfer tax usually paid by the seller, but sometimes when you buy a sponsor unit, most of the time sponsor put that expense on the buyer. Because sponsor unit, they know that it's desirable units, you don't have to pass a board. You could, most of the time you could rent right away, sometimes you still cannot. But biggest obstacle, you don't have to go through board approval. So they pay a little bit more, and they absorb the cost of the transfer tax. Let's see. I think that's all in a nutshell. You asked me to cover. You asked me to cover the co-op, the difference between condo and house. You asked me to see what kind of programs available for co-ops. We have a lot of programs for first-time buyer, depending on the income of the borrowers. SONYMA looks at the family income, while Home Ready looks at the borrower's income. So when we qualify for a particular program, there's a different qualification we have to keep an eye on, because each program has its, well, every program you're going to have a pros and cons. We just got to make sure that pro is much bigger than cons, and the client qualifies. Do you guys have any questions? I don't know. I could talk about co-ops and condos for hours. Any questions? Did I bore you to death? Is everybody there? Nobody fall asleep? Hello. Say hello.
Hi, Olga. I'm here, but I'm working. It's Kit Kat. How are you?
Okay. How are you? Well, you don't.
I'm fine.
You don't.
But I'm listening.
Co-op. You do a lot of houses.
I'm sorry you went out. I didn't hear you.
Kate, I know that you do a lot of houses. You don't do as much co-ops.
You never know. It's always good to have the knowledge. So I really appreciate you giving this training. So either way, I'm here, but I am working. So
Appreciate it. Thank you.
okay then.
Okay, guys, I appreciate you having me. I hope you got some knowledge. I hope you got some information that will be useful to you. And if you need any help, I'm here to help you.
You know, I do want to ask you a question. You know, normally if I take anyone out, I'm always making sure that they're pre-approved. But what if they're pre-approved? I know we went through this before. Would you be willing to still advise on a co-op? Because I'm not an expert when it comes to the co-op.
Absolutely.
All right, then. Thank you.
Okay. I will answer the question. It doesn't mean that if you call me, or you must give me the deal. I'm here to pay forward. I get a lot of deals from this office. I've been working for 20 years with this office, so I'm here to just share my knowledge. And if a deal, listen, sometimes I help Kate, but a deal will come from a different person. Let's say a deal will come from Steve while I'm helping Kate. So the universe always have ability to give back.
Hi, Olga.
Hi.
Timur,
Thank you.
have a question. Please check in the chat.
Okay, sure. I don't want to reading it from Chase, it was pre-approved with the amount, transfer to federal savings account. Chase will not really get federal numbers, they were doing it with diligence, he gave with savings cash. That's the president that we are looking for a Park City. I don't believe he will get approved for Park City, which is illegal. He's looking for now for 400 million, or some options to do. With $58,000, $400,000 purchase will be very aggressive. Remember, bank might approve you, but the board might not. So what you do is you take 58,000, divide by 12. So you have 58,000 divided by 12. That's 4833. Multiply by, let's say, 35% to be an aggressive. Your debt to income ratio cannot be more than $1,691. So if he wants to buy for 400K unit, that means a maintenance is going to be at least $900, but let's say even $700, right? That leaves you a mortgage of $991. How much down payment he's putting? He's going to take $200,000 loan, right? On a $200,000 loan, even aggressively, let's say we're going to do 6.1. That's $1,211, and they need to have $991. So they're $100 off. That's without having any other debt. Plus, it's also using 6.1, which is Sonoma rate, and it's going to be tough. The best way you could do, try to get a cosigner.
Okay, thank you, Olga. That's what we're working on right now, to add another income from one of the family members.
Now, you're saying that it's Park City, Park City 254.
He's looking in Park City. That's where all the units that we've looked at so far, that's where he wants.
Fine. Double check if the federal union had that building approved.
Okay, I'll find out from the lender.
Chase is usually very good with private approval. Federal unions are much tougher because they're not really great for co-ops. So before you switch the client, make sure they know the private.
It's not Federal Credit Union. It's our lender, Brian from Federal Savings.
Oh, right. Okay, well, Brian probably will know exactly where to place the file. Just make sure their co-op is approved on that particular amendment, that's all. But,
Okay, thank you very much. I appreciate it.
Bank will approve them. The co-op, you gotta double check the debt income ratio, the reserve requirement. I think you're better off to do the cosign.
Okay, thank you.
Sure. Did I miss anything else?
Good morning. My name is Jennifer. I'm a new agent. I just wanted to know what's the best way to reach you should I have any questions in the future.
Sure. My number is 917-854-4657. And my email, I'm going to type it here. Can I type it here?
Perfect. Thank you so much.
Yeah, you could reach me or you could text me and I'll send you my business card.
Okay,
Again,
no problem.
917-854-4657, Olga Sevilla. Jennifer, can you put it in on the message, my contact, if you don't mind?
I'll handle it, Olga.
Thank you so much, Olga. Thank you.
Guys, bye.
Thank you. Bye-bye. the